To that, we'll just add in what represented the weekend well. That no, can't do that. How about a terrifying chart? There we go. There's your performance of everything this year. NASDAQ 100 going back to 2021. Look at gold. Look at silver. Look at everything else. NASDAQ 100. We're going to talk about momentum. We're going to do the runner at 9 a.m. as we always do. I hope everybody had a good weekend. Anything exciting happen? Please let us know because we're always looking for excitement in this environment. Natural gas is our leader this morning. 6.6%. Gold up to 43.30. We're going to talk a little bit about that. We'll talk about silver pushing back to 51.20. JP Morgan with a very aggressive forecast on gold prices. Platinum doing the same thing. Copper moving as well. Bitcoin, gold, again, the quote-unquote debasement trade rides again. And the Nikkei moving higher on some positive emphasis around their central banking system, what they're going to be doing. What's lagging this morning? Well, live cattle, feeder cattle, not something we're really focused on here, but we're going to keep an eye on platinum. We're going to keep an eye on silver, and we're obviously in focus around copper to keep an eye on what China is going to do next, largely on the back of the new kind of shift in policy that transpired over the weekend. All right, so as you all know, if you are not joining us before 9:30, these are the types of weeks that, I mean, I read a lot, and everyone seems to have this very comparable, similar argument around different stools in which this entire economy is holding up. Interestingly enough, really good article written yesterday by Andrew Ross Sorkin about 1929 and talking about how debt has always been the consistent theme of major downturns in the market. He has a new book coming out tomorrow called 1929, which is almost a follow-up to the Too Big to Fail, which is one of the seminal books of the 2008 financial crisis. A lot of people talking about valuations, a lot of people talking about different bullish components, but also very bearish components. And again, the debasement trade remaining in focus. We're going to get a CPI this week, which is going to be pretty interesting as well. And we have a lot of earnings reports with names like Tesla. So why does all of this matter? Because you're going to see these mornings this week where you're going to see 1% moves, possible 1.5% moves on the Russell, on the S&P 500, and that can lead to sell-offs. We could see sell-offs in the morning, and then all of a sudden the markets start to revert back in that morning and afternoon trade. And why does all of this matter? Because you could see 2, 3, 4% moves this week based on headlines, based on earnings, based on CPI, but it's not going to be straight up or straight down. It's going to be in this chop. And it's very important to understand things like volume weighted average price, things like monkey bars, things like volatility and expected price move. And that's what we're here to do, to guide you through a very critical week that I honestly think can make or break your year. Momentum on the Russell 2000 is negative. And a lot of people don't see it, but it's very clear that the underlying structure in the United States and the concerns around U.S. debt, concerns around the U.S. economy, concerns around the job market, it's still all here. It hasn't gone away. But remember, on the debt side, we have 40% of companies on the Russell that are in the zombie stock world. And why does that matter? Well, these companies will be drastically impacted by, well, again, lending costs. And the focus remains on the Fed. Is the Fed going to cut? Is the Fed going to cut? Is the Fed going to cut? But really, at the end of the day, it's the fact that we are experiencing challenges and problems in our banking sector, in our private credit sector. And you're watching names, very volatile names, very most strong momentum names, like HIMSS, for example, that has been bouncing around based on liquidity and based on momentum. And now a big move down that we just witnessed last week. The stock fell 15% on Friday. TWST dropping another 8.4%. So the Russell really is the canary in the coal mine at the moment. And with the S&P 500, strength is in names like Tesla and Ford. But on the broader side, again, consumer cyclicals, materials, technology stocks under pressure. Sector-wide, as we'll discuss in a moment, energy under pressure, financial under pressure, consumer cyclical under pressure, and technology under pressure. Those are the four primary momentum sectors. So it's very critical to be cautious this week. We are seeing this move up this morning from the weekend. We'll talk about why that's transpiring and what the headline is around it. But at the end of the day, the purpose of the market is to sell. This is going to be an interesting week. So be very busy, be very active. Remember to take smaller gains. Very simple thing. Like if you're constantly targeting 50%, no, focus on the key technicals, focus on taking gains as they arrive, and we will continue to trade on the macro side. Good morning, Asanta. Good morning, Eric. Good to see you. And Jerry joining us as well. Beijing has shifted its stance. Okay, let's do this now. Again, threatening export bans last week. That was a key driver of the big move down in the last 2 Fridays ago. Well, now China will meet with Treasury Secretary Bessent in Malaysia. Remember, neither of these two countries can afford this. Neither of these two countries can afford a massive financial standoff in this world. Yes, the long-term focus on this global financial system will be more multipolar, meaning that China will go one way and have its list of partnerships, and maybe the BRICS are aligned, and then you'll have, and BRICS are again Brazil, Russia, India, China, South Africa, and all of the other major producers of food and copper and everything else, and we'll maintain our financialized world with the Western partners, with Japan and France and Europe and Canada. A lot of Canada. Well, right now, they can't afford this. China uses the dollar as much as we do. It's part of the international trade system, and they have not completely and totally been able to break that, let alone do they want the responsibility of being the largest player in the reserve system, because again, the reserve system, the dollar reserve system, which the United States is the reserve currency of the global markets, negatively impacts manufacturing in that domestic country. In the United States, domestic manufacturing has fallen from 20-some% to 11%, largely on the back of the dollar. China can't afford that. China is the manufacturing center of Earth. So even if they maintain all of that rare earth leverage, and they maintain all of these various different types of powers, they have vulnerabilities. And the United States can exploit them, and China can. We can have this standoff, and we can both sink at the same time. So Bessent reaching out. And now what's interesting about this is that this is going to impact all of those names that we have discussed around rare earths. We've talked about a lot of different companies that were engaged in the choke points here in the U.S. economy. The choke points around very specific rare earths, where only 1 or 2 companies really had an insider edge. You're seeing USAMY spike 13% today. You're seeing USAR spike 6% today. These stocks are going to be volatile for the next couple of days, and until at least we have that meeting. So if you're trading these and you're trying to take action, it's really going to be important to take this down from a daily to an intraday perspective, focusing on hourly charts, focusing on 30-minute charts, really tightening things up. Stay away from the 1 minute, but focus on the 3, the 5, the 15, and look for momentum to return and stay between these lines. Look to go from 11 to 12. Look to go from 12 to 14. Look to short from 12 to 10. Key technical lines, key focus on basic discipline this week. FXI, Alibaba, all of the names linked to China, all of the AI plays, everything is backed on this trade. So sudden reversals can signal some policy volatility. Look again for, hate to say it, insider buying, but also pay very close attention to unusual options activity and unusual volume, because we have seen a lot of people front-running policy decisions, even though That's not supposed to be happening. Tech, industrials, defensive equities will be in play for a sharp repricing this week. And again, headlines will drive volatility. Meanwhile, gold, it's gold. It's the meme stock, right? It's crazy to say, but this is, again, what has transpired because of a global shift in the financial system that has been transpiring largely since the late 2023. Gold extended its ninth straight week of gains. It hit 43.30 this morning. Forgive me, I was at 42.40 when I was up at 6 o'clock. JP Morgan said if 0.5% of foreign held assets rotate, that's not that big of a number. But again, a lot of foreign assets are held here in the United States for a large number of reasons, but particularly because we are the reserve currency and also because we are the only game in town. If they rotate out just 0.5% of those U.S. assets that are owned, gold could easily reach 6,000, says JP Morgan. Again, GLD, GDX, Newmont, Gold, Royal Gold. It is the neutral reserve. We are seeing central banks now having more gold than U.S. dollars in their reserves. It's the first time that happened since 1996. ETF inflows are accelerating. We talked about this last week. Money flowing into the ETFs. ETFs have to catch up in purchasing. And it is, again, that structural paradigm shift in global reserves. I have talked about this to the point that it's almost getting annoying for some people. They're like, stop talking about this. This is a Wendy's. But this is, again, TheoTrade.com, the next 36 months. We've talked about this extensively, particularly since I joined here in April. This was a pretty significant look at how capital operates and what the core playbook is for devaluation and this rotation out of the US dollar. So I threw that into the chat. Make sure that both chats have that. Give me 1 second. All right. Beyond double today. Hey, really? Oh, give me a break. They're going under. Don't worry about it. Selling spreads to the downside. Remember, looking at companies like NEM, Newmont, going out and looking for a 15, 20% below where their current prices are and selling spreads. I'm down here at the $80 level. I'm down here at the 85 level. I'm still long gold, and I will remain so for the next 10 years. Oil prices, however, down today, 3 weeks in a row. And this is geopolitical, but it's also very, very heavily emphasizing the geopolitical focus in addition to the technical side. So energy equities are diverging from their commodities. Pay attention to Exxon and Chevron and the XLE. This is a challenge here, right? Because energy is going down at a time that gold is rallying, and that can create more rotation trades. That can see a lot of people continuing to pile out of the energy side. XLE is in focus. I want you to pay very close attention. Don't make any trade on this yet. You were looking for oversold on the relative strength index and the money flow index. Relative strength index is a price momentum oscillator. Money flow index is price plus volume. And when we get into oversold territory on oil energy stocks, particularly on the XLE, that becomes the contrarian opportunity to look for a reversal. I like to try to make that trade 2 to 3 times a year. So I'm going to be very patient. We're still kind of in a little bit of no man's land. I'll also pay very close attention to the MACD, right? The MACD, which is, again, a very critical short-term momentum oscillator that is very important to be paying attention to. This is a really good question from Showland. And I want to just point this out. So the idea is of WTI crude, which is the U.S. benchmark crude, being in what is called contango. Contango is a term in the futures market that basically describes the futures curve of oil. So what the expected price is of oil at a contract expiration, say November 17th versus January of 2026. When futures prices for a commodity like Brent WTI crude are higher than the current spot price, in or near-term contracts. That's called contango. The opposite's called backwardation. That's where near-term prices are higher than futures farther out. So if WTI spot is at $50 a barrel today, but the futures price out 6 months is 70, that's contango. And it happens because of basic things like storage costs, holding crude. It requires tanks and pipelines and insurance and financing. Those costs push prices higher. A lot of things being in storage push crude prices higher. Financing prices are critical. Market expectations are critical. And for us, contango allows a cash and carry arbitrage. We'll talk a little bit about oil markets today at 3 o'clock when I am back on. I really like this question because it's not something that I get to talk about on a regular basis, and it will not put you to sleep, I assure you. Again, OPEC reaction will be the key catalyst to watch. They were supposed to continue to increase production. We'll be talking a little bit more about that. And then, again, we're going to get to the runner in a second, but this is a busy week. It's a really busy week. This is where, because of the lack of the CPI and because of the fact that the Fed meeting is at the end of the month, the emphasis here is heavy on earnings. So Tesla, Netflix, Intel, Coca-Cola, defense contractors all reporting. Great opportunity to react to those earnings reports. You could see some very significant moves, and the defense contractors also critical. Because of that CPI release from the shutdown being delayed, that comes out later this week. We'll probably get some sort of additional Fed reading on inflation next Friday. But again, the meeting for the Fed next week. Key thing to keep in mind right now is just the fact that expectations remain the same for the Fed cut for that October 29th meeting. It is currently sitting at 99% for December, for October, and December 94% for a second cut. I think we should just get it over with now and just go the full 50 basis points, but what do I know? Volatility setup unlike typical weeks. So once again, this is going to be a very busy period of time. There's going to be a lot of opportunity to make very, very simple trades, looking for reversals, particularly post-earnings. And once again, volatility coming from that CPI data. Keep a very close eye as well on the regional banking stocks because of the pressure that we saw last week. Finally, trade war and shutdown wildcard. So now they're saying it's possibility that we're going to have a shutdown all the way into Thanksgiving. So why not, right? So again, that creates blindness for a lot of people around how to basically try to trade this entire shutdown situation. Now, I don't know what the end goal is going to be in mind at this point. I continue to monitor it. I continue to read it. It's very clear that everybody is very far off from a rational solution. But the big problem here is that you do have a lack of data. We have an FOMC blackout period as well, meaning nobody's going to be talking for the next 9 days. We have no data. That leads to some relatively significant shifts. And we're not seeing right now where certain other reports are as far as what hedge funds are doing with some money. We have to be very, very cautious in this environment because this can lead to very wild swings because the forecasting that we typically can rely upon and the type of price action due to transparency in government data on which the market relies, it's gone right now. The only thing that I can really compare this to is back in February of 2022, where the market was really, really selling off. And one of the reasons for that was because we were completely blind to all of the hedge fund activity because the commitment of traders report was completely shot due to a data breach from one of their primary data sources. So Trump came out saying that this is not sustainable for the 100% tariffs. I don't know who talked him into that and talked some sense into it, but now formalizing 25% tariffs on foreign trucks. And why does this matter? Because it's targeted. And the targeted focus on these tariffs rather than blanket tariffs creates winners and losers, but it leads to potentially wild swings in individual industries and sectors that are negatively impacted or positively impacted by policy. We saw this happen with the rare earths, right? We saw these massive moves on UAMY and USAR. And right now, what we have to do is recognize that this is going to impact the trucking industry. We're seeing Ford moving higher. This is kind of where we have these whipsaw market reactions. The pros will thrive when the amateurs freeze in this environment. But with missing data, we are blind, and technicals and flows become crucial to monitor. Again, pay very close attention to options flow. Sorry for the delay, Charlie. Okay. All right. Take a couple of questions real quick. I am here late. Did I miss the runner? Nope. I just kept talking. I apologize, but that's okay. David, you're here. We got it. We're here. 50 basis points means something you don't see as broken. I agree with you. No, I don't think it that way. I think that it is a full admission that they are wrong. That's the problem, right? They know something's broken. We know something's broken. We've had 3 subprime events transpire, private credit events transpire. These are big warning signs. And it's very, very, again, timely that Sorkin's book comes out tomorrow, because as Sorkin wrote about, and I think it was one of the better pieces written in financial media in a while, that basically breaks down the fact that the guy who basically pushed for democratization of finance in 1920, Mitchell, makes the exact same argument that Robinhood's CEO makes. It's like, it's almost down to the word. And it's like democratization, private credit, let's get all of this illiquid stuff into people's into people's 401ks. It's dead on, and it's poetically perfect, because it speaks exactly to the late stage that we're in on this market, because there is a lot of illiquid crap out there, and boy, do a lot of these banks want to just dump that onto the retail trader while they still can. All right. Ethereum, blah, 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 blah. Red runner, better late than never. Look at that. Hey, you're fine. It's going to be great. It's going to be great. Ford Motor Company. This is a no-brainer. We're going to look for some continued momentum. You're going to keep a relatively short leash on this trade, looking for this little short-term bounce. This is in a very strong move last couple of days on the daily, on our hourly as well, coming out of this period, 1140 up to 1149. Want to stay on that hourly above that 8 adjusted. So that is an 8-hour line. But right now, as I look at this, I mean, I don't want to sell spreads on this. I want to try to be a little bit aggressive with this, and my hope is that it can maintain its momentum. This is a stock to revisit multiple times this week. It's a stock to revisit from a spread perspective multiple times this week. Next Friday, the 11 is currently, will probably trade somewhere around $1 to $1.05. If you bought the 11 and sold the 12.50, it's an $86 trade for 64, and your break even's right where you are, right? So that's kind of it. Rather than buying the stock, I can just, and that's kind of the way that I'm setting this trade up. Rather than putting down $1,193 for a call spread, instead what I'm doing is I'm utilizing the leverage of the market, putting down $86, maybe $90, getting an opportunity to make the 60 to 70 bucks, and now utilizing the leverage with a couple of contracts. So once again, you could buy the stock and maybe you can make 50 bucks if we get back to 1250, or you could utilize the leverage and put down 3 of these contracts. It'll cost you 250 bucks with a shot to make 180. So that is, again, trading into earnings. That's the key thing, trading into earnings, not through it. You can also do exactly what Eric is recommending. Okay. Next, what do we got? Oh, ADI. Oh, man, this thing. Analog devices. There's some strength here, but this is one of those names that semiconductors technology remains negative at the moment. So, again, we need to see SOXL pick back up. SOXL has been under some pressure, right? It's had some chop right from this lower period, but last couple of days improving SOXL. So want to see that hold above like 1030 today. NVIDIA will be obviously the core focus for the next couple of days, particularly with Tesla reporting earnings later this week and the relationship between those magnificent seven stocks. What we're trying to look for on ADI is just continued momentum and a revisit back to that 248 level. So once again, setting up a trade that allows me to do that is effectively staying in the money and selling out of the money. 250 up to the 240 to the 250, 245 to the 250 going out 2 to 3 weeks. NRO. Ford's going to really be my focus at the moment. Consumer cyclical stocks, again, auto part companies, these stocks have been under pressure. Obviously, the cyclicals are under pressure, but these can be the winners, and we're starting to see continued strength. RSI, MFI, MACD here, looking for a positive switch over. MRNO, I don't think has a very strong options chain. It does not. But buying the stock and looking for a revisit back to that 1864 level. There you go. On the weak side, interactive, every brokerage is getting beaten up, it seems. I don't know what's going on, but well, I know what's going on, but this needs to drop under its 200, or forgive me, it's 50 before I try to do anything about this. This is kind of in no man's land at the moment. So keep a close eye on this. Just watch it, see if it bounces again off of the 65.30 level and starts to revert, and we see financial stocks improve. That's beneficial. But once again, this is all about momentum. The FAZ, which again is what we watch on the daily bearish ETF, it's still pushing higher. It's still in kind of a more of a breakout mode. So if the FAZ continues to rise, if the KRE continues to drop, resumes its selling, then Interactive Brokers and the rest of those players should be continued short. Trade Desk, same thing. Trade Desk, yikes, right? Same thing, short down to 45. But again, this is all built around specific momentum. Communications are actually positive at the moment. UVXY, FDP. Well, this is Don, right? Keep a very close eye on volatility. We're back under, right, the 50-day, which is, this is critical. This is where the money will be made. If volatility will cool off, and then all of a sudden something new will happen. Watch the UVXY on the 1 hour and the daily. Again, once we get back above that 50, that's where I typically will be long volatility, and typically where I will be long the SH, which is the inverse ETF for the S&P 500. And finally, pay attention to the food. They're buying the food again. They're buying it. This is the one thing that we talked about last week. They're buying up the metals, they're buying up the metals, they're buying up the metals, then they buy the food. FDP has a very strong F score, very strong Graham score. And as we've seen with these moves above these key moving averages with a name like FDP, what we tend to see are these, $7, $8 moves and then a little bit of a pullback. So we're getting back to these key averages, and we're looking for strength to return back into this 38, 40 possible new highs. Crossover positive on the MACD, crossover positive ADX, crossover passover here on RSI. I want to see some volume support, obviously, but I just like the stock. I like the company. I have no complaints about it. And once again, how do you trade it? Again, defensives are starting to move a little bit, and that is important. Again, with back at that EMA. So maybe a stop back here at that $34 level. I'm looking for continued momentum up to the 38. 917. You've got questions. I have at least an answer. Yes, and in the money call spread. Yep. Schwab Jr. Thank you, Eric. All right. Other side here. I think, yeah, again, one of the major things that I want to just point out today, as we had discussed, this is going to be a interesting week, particularly for institutional flow and obviously where capital is moving. So one of the major things that we want to be focusing on is trying to understand where that money is moving and the tools that are necessary in order to do that. So if you're in our chat, take a look at the 3 new ghost prints that are in progress. We have a link there as well. Get your spot before the signal is released. In addition to that, UK Ray, no problem. I hope you have a great day as well. If you keep talking, I'll get smarter. I can't promise you that. Past performance does not indicate future activity. Finally, just a real quick look at the futures as we move into today. One of the key things here is really going to be around this copper number. And I know that Blake talks about this very often. I don't talk about it as much because my focus is usually on U.S. monetary policy. I don't spend an exorbitant amount of time talking about China, but I will point something out. The AD line, the ADX, this is the key thing that we have to be watching because, as I've noted, when it comes to the United States, and we're in the middle of obviously a weak period here, right, with our regional banks, concerns about private credit, concerns about private equity. You see these names like KKR selling off. All of that is linked to liquidity in the financial system, concerns around debt, etc., right? The United States is a financialized economy. It means that we operate on paper dollars. We have more ETFs today than we have individual stocks. We perpetuate the ongoing quantitative easing and all of these other terms that you hear, but the reality is that we don't make anything. Like our manufacturing is about 10 to 11% of our economy. We don't make anything. Now, the dollar's largely responsible for that. But I point something out. When the United States engages in QE, when the Fed prints, when we move from quantitative tightening, which is likely going to end very soon, to quantitative easing, our bank stocks go up. Yes, Rosario, correct. But even though there is a house of cards component to it, it's not that terribly hard to track and to understand. And once you see it for what it is and you understand how the system operates, you're going to be very successful because, again, utilizing momentum, understanding liquidity, following what insiders do, all of these things are interlinked because it's been the same story over and over again since at least 1987. My point on this, though, is over in China, when they print, it's not their banks that go up. It's their manufacturing. It's their AI companies. It's their Alibabas. It's copper. So when we see copper dropping and dropping sharply, it can potentially be a sign of significant issues in the Chinese economy and the plumbing of the Chinese economy. So it's very important for us to keep an eye on this because it tells us whether or not China is expected to continue to maintain its soft monetary policy, which has honestly been one of the key drivers of the success of the markets in 2025. It is 9:20. Don's here. He's going to be here. He's going to play some music. And then he's going to talk a little bit about Vol. He's going to walk you through why this week is unlike any of the other weeks that we have seen going back, I want to say since mid-2024, possibly since the Japanese Nikkei crash back in August 2024. There's a lot of activity. It's a great opportunity. If you are new and you have questions, obviously put those charts in the chat, questions in the chat. And once again, as I remind you, support at TheoTrade.com. If you're trying to reach any of us, put our name in the subject line. Rosario's last question. You are a student of financial history. Being a house of cards never ends well. Am I correct? Well, here's the key thing. It can go on a lot longer than you think it does. And as I noted again, and I think that this will probably be well noted in Sorkin's book, the United States, its entire history, has been built on consistent crisis, as is basically everything since Italy in the 1500s. So you move from crisis to crisis, and what really matters is how you manage it. And while it might seem like a house of cards, there's more opportunity than you can anticipate because you can arbitrage the crisis into real opportunity. You're going to get a couple of these a year, possibly some big ones over the next decade. The question is how you prepare yourself and whether you take that mentality and think that you're kind of a victim to it, or if you're going to be a person who's going to go and attack it and make money from literally like 2008, 2020, 2025 were some of the best opportunities to take back a lot of losses that retail endured. You just have to understand how the system works, and we'll continue to talk more about that later. I'm not wearing the kilt, but I'm going to wrap it up. I hope you guys have a great trading day. I will catch up with you today at 3 o'clock. Take care.